in the short term, technicals certainly at risk here. Markets are looking to open a little bit lower this morning. Dow's down about 176 points this morning. Of course, that can change pretty quick. Markets flirting with that 200-day moving average, and we certainly want to pay attention to that. Here's what you need to know before the bell this morning. The market is certainly kind of working within this correctional phase, that correctional weakness, that summer weakness running through the month of October. As we've stated before, that's certainly well within the context of normality, particularly within a pre-election year as we're in right now. Weakness tends to run through the month of October, and then you get better performance as we get into November, December, certainly playing along with that. But in the short term, technicals certainly at risk here. Markets are looking to open a little bit lower this morning. Dow's now at about 176 points this morning. Of course, that can change pretty quick, but markets flirting with that 200-day moving average, and we certainly want to pay attention to that. Now, as we've talked about before, be real careful with technical analysis. One of the mistakes that people make is that as soon as you get a break of a moving average, it's like, oh, I got to sell. It broke the moving average, I've got to sell because that's my stop. Be a little careful with that, because more often than not, what will happen is markets will break a particular moving average and then immediately recover and go right back above it. And this is why a lot of people get frustrated by technical analysis, like, oh, it doesn't work, it broke the 200-day, then turned right around and went up, I got stopped out of everything, and I missed the rally. That happens a lot. So what you're looking for here is what we call a confirmed break of the 200-day moving average. So you're looking for the break of the moving average to occur with some kind of veracity. And Friday we closed just barely below it. So that doesn't, we're sitting on it right now. We're just a little bit below it. But you're looking for a confirmed break below that, the market to come back up, retest that 200-day moving average, and then fail at that 200-day moving average. If that occurs, that is a confirmed break of the 200-day. That is your sell signal to reduce equity risk in your portfolios. Be real careful, as I said, though, with these real short-term breaks, because again, it's not uncommon to see the market break this, then turn right around and turn back up for a rally. And again, this is where you get frustrated in a lot of cases. Markets are oversold here on a short-term basis. We did re-trigger that MACD sell signal, but it's at a pretty low level, which suggests that downside is probably limited in this rally. So again, even if we do kind of break this 200-day moving average, there's a lot of support sitting here right at 4,200, and then you've got a lot more support sitting right around 4,100 and then 4,000. So again, when you kind of take a look at the markets where they are, there's a lot of the selling pressure has been done. If we go back to the March lows to the June, July highs, we've already completed a 50% retracement of that advance. So again, now normally that's about what you would expect in a corrective phase. So we're probably closer to the end of this correction than not. And then of course, as I said, that kind of sets us up for that November, December rally. You've got your stock buybacks starting in November. Then you've got basically year-end performance chasing and rebalancing by mutual funds into December. Doesn't mean it's going to be just a straight up shot by any stretch of the imagination, but more than likely you're going to have a little bit more upside the market. I would use that rally to begin reducing risk in your portfolio before we get into 2024, because next year may be a very different story. That's what you need to know before the bell this morning.